There is a lot of quotes and a lot of bullish commentary on the price of oil from a group of oil watchers around the world interviewed by Bloomberg Television, includes several CEOs of major producers. For more on our top line story and for his outlook on where markets are going, we're joined now by John O'Connell. He's Chief Executive Officer of Davis Rea Ltd. John, great to have you with us this morning. We've got lots to talk about. The news from OPEC Plus looks like it is going to be a very modest increase to production, and oil prices have turned around this morning, moving from negative to positive territory. What's your view of this oil market? Lots of debate over there as to whether prices can remain this strong over the longer term or not.
Yeah, good morning, Paul. And I apologize for having the audio difficulties. The one thing that makes me nervous is that everybody sort of is in agreement that oil prices will remain elevated at these high prices for quite some time. I think that seems like the reasonable argument, and sometimes the consensus is not always wrong. Goldman Sachs was out earlier on saying that the oil market's in a deficit of around 2 million barrels. That seems reasonable. The announcement of about a 100,000 barrel a day increase in oil production is, I think, in line with what a lot of people sort of thought. The debate really is how much excess capacity does OPEC actually really have to produce, and what countries can actually increase their production, and how much of a deficit are we really experiencing, particularly in North America. I think right now, one of the things that's pushing crude prices and spreads wider between North American oil and, let's say, Brent crude oil is the release of the strategic petroleum reserves in America. That will run out fairly soon. So I think, in the fall, all things being equal, we should see an increase in crude oil prices as the year continues to progress. The offsets are obviously weakness in China. We're seeing slowing economic activity in China, but we're also seeing increased consumption in Europe potentially in the fall as they look for alternative sources to keep themselves warm over the winter holiday season. So I think it's a mixed bag, and it certainly proves that as we underinvested and then we had crude oil prices trading way below marginal cost globally between, let's say, 2016 and 2020, there's been massive underinvestment, and we're really sowing the seeds, reaping the seeds of that right now. And it's very reasonable to expect that we'll continue to see underinvestment and more discipline, particularly in the North American producers, for the time being.
And the most recent news from Vienna is that OPEC Plus has now formally approved an increase of 100,000 barrels of additional oil supply to begin in September. That's the smallest increase that OPEC or OPEC Plus has ever announced, and oil, as we continue to show you, is moving higher on that news. It's now trading above $96 per barrel. John, let's finish this conversation with your views on the Canadian oil and gas producers. They've been a source of strength, perhaps the only real source of strength in the Canadian stock market for some time.
Yeah, you're absolutely right. It's been really the only area of strength in Canada. They're all trading at very, very reasonable valuations. There's a lot of capital that's been going on. There has been very low issuance of equity because they're making so much money. They don't need to raise money. And so the demand has been strong for shares of oil and gas companies while the supply has not been increasing. We're seeing good dividend increases, valuations trading at around 3.5 times EV to EBITDA multiples, which is very reasonable. So what it's really showing you, I think, is that investors are skeptical that oil prices will trade above or at these levels for an extended period of time, and how sustainable are these profits. I think what investors may be missing is that corporations are aggressively buying back their shares, so they're shrinking the number of the share count. So valuations should still stay relatively attractive down the road, as long as these companies remain disciplined about not increasing production at unprofitable rates. And really, I think that the final thing is that we are beginning to see cost increases through the oil patch. So clearly, energy companies are increasing drilling. They're going to chase that marginal dollar of profit. So we're starting to see the service providers increase price. So that will tend to crimp margins a little bit. But nonetheless, I think profitability is so strong right now that there's no reason to think those margin pressures will be anything but a minor hiccup for the time being. So I think, investors have to get comfortable whether they think these prices are sustainable, and they certainly seem to be sustainable for at least a year or two.